What is interest deductibility? So in New Zealand, we've seen so many changes to tax rules for residential property over the last few years. So interest has been deductible as an expense for a long time, then it got changed and it wasn't allowed, and now it's been reinstated and it's back. A lot of people don't fully grasp why this makes such a big difference to the financial picture of a rental property. So generally speaking, if you take on debt to earn income, whether that's for a business, an equipment purchase, or property, the interest on that debt can typically be deducted from your income. So for property investors, this means that you can deduct your interest expenses from the rental income you earn. So let's look at a simple example. So say you've borrowed $500,000 at 5% to buy property. That's $25,000 a year in interest costs. If your rental income is $30,000, and let's just ignore other expenses like insurance and rates to keep things simple. So without interest deductibility, you've got $30,000 of income at 30% tax, $9,000 tax. So after paying interest, you're left with $5,000. But you've still got to pay that $9,000 tax bill, meaning you're out of pocket. With interest deductibility, you've got the same income of $30,000, same interest of $25,000, but your net income is $5,000, which means you've only got tax at 30% at $1,500. The actual expense hasn't changed. You're still paying $25,000 interest either way. But the tax treatment makes a massive difference to your bottom line. So that's why when interest deductibility was removed, rental properties that looked good before became unattractive for investors.